If we look at the big picture, we have to be very careful because some economies are sort of expanding and have bottomed out. I mean, I would say in Asia, we've probably bottomed out, and also the markets have bottomed out relative to the US around the turn of the year. And since then, many markets in Asia have outperformed the US, out also in Europe. And then we have economies that are very mature in the business cycle, which are turning down. So we have to be very country specific and also stock specific. As a general trend, for the last 10 years, it was good to invest in indices and in the popular stocks like the FANG 7 and semiconductors and so forth. Going forward, I think it will be very stock specific. I mean, I look, say, at different sectors in the market, and within sectors we have, say, about banks. Some banks have performed well and some banks haven't performed well. Therefore, as an investor, I think some caution will be in order. Number two, my view is that, as you know, since essentially 2009, at the low in March 2009, the S&P at 666, we've had a rise in the S&P, an outperformance of the S&P and especially of the Nasdaq vis-a-vis everything else. And we also had strength in the US dollar. And since Trump was elected, we have more weakness in the dollar. And so the difficulty in monetary inflation, such as we have, is how do we value assets? Do we value them in US dollars or in euros or in Brazilian real or in Singapore dollars or in gold, silver, platinum, or whatever? And I think if we value in dollars, the market driven by liquidity. We have increased interest rates in the world since 2020, but the liquidity has continued to expand. The level of interest rates doesn't tell you whether money is tight or not. You could have, like in Turkey, interest rates around 80% and still easy monetary policies. Or in Zimbabwe, they had interest rates at 1,000% and money was still expanding. So that doesn't tell you anything. And this is the difficulty. The economies are not doing particularly well for the typical household. Let's say a household that gets a salary, the father works in a factory or in an office or whatnot, and he gets maybe a salary increase at the end of the year, but it doesn't match. The cost of living increases. So in real terms, actually, his purchasing power is going down. And we have many statistics actually compiled at the Federal Reserve by the academics. And they show that the typical household in America, when they reach 35 years old, they are less well off and they earn less than the parents earned, say, 40 years ago. And this is a sign of a decline in the purchasing power of money and in the standards of living of people. And I see it very clearly when I travel through Europe. The standards of living, there are lots of people, they really struggle. They're not hungry, but to meet their bills and to have some discretionary spending power, they are struggling. Same in the US. I mean, you go to smaller cities, to smaller communities, it's not a pretty picture. On the other hand, when I travel to China and to India and to Indonesia and I compare it to how these countries were 50 years ago when I came to Asia. I came to Asia in 1973. At that time, most of these countries were dirt poor and people had no economic freedom and no spending power. The Americans, they always complain that the Chinese are not spending. This is a complete idiocy. They are spending, of course, a lot, but they're not spending a lot on American goods. They're spending a lot on goods manufactured in China, and they travel a lot. I mean, 3 years ago, there were 140 million Chinese traveling overseas. After COVID, it fell and then it recovered. But some Chinese are shifting the traveling plans from, say, this country to another country and so forth. And now we have India. There's also 1 billion people. And I don't think these countries will be rich in terms of GDP per capita, such as we have in Monaco and in America and in Florida and in Switzerland and so forth. but they will be rich in terms of market size. The market will be huge. When 1 billion people consumes, is more than when 300 million people consume. For the investment community, this is the most important question. And this has been observed already in the 16th century. When you print money, you drop money onto the world. The money doesn't lift prices evenly. So look at, say, a room, and the money is falling down from the ceiling. The money then will flow into one corner of the room, or into another corner of the room, or maybe into the middle of the room for a while. And that corner, or wherever the money flows to, will be inflated. So the prices will go up. And then one day someone will wake up and say, oh, the prices here are high and over here they're low. So let's buy something here. And then what will happen is that this will go up and this will go down and so forth. And depending on the quantity of money, the total amount, say the market capitalization of all the stock markets in the world can still go up. But it doesn't mean that the salaries and the standards of living of people go up. I mean, if I had to describe the last 40 years, the financial people will all tell you that they work hard and so forth. I can tell you, go once on a farm and see how the farmers work, who pick up potatoes, or go into a coal mine 100 years ago. Nowadays it's better, but it's still, to work in any mining operation is very tough. Anyway, we the financial people, because we are the intermediaries of the money that is created by Mr. Bernanke with his helicopter that falls down, it falls first to us, and we then invest it somewhere else. So the more money is being printed, the more we benefit. That's why Wall Street and all the financial centers, they will never argue for tight money. They don't want tight money. They want easy money. And the portfolio managers, if you're the head of Fidelity or the head of whatever, BlackRock, are you going to tell your clients, we must tighten monetary conditions and the stock market will crash as a result? No, you tell them these policies are very desirable and what they're not telling the people that the realities. If you look at the price of gold, say in 1970, before the US went off the gold window, the price of gold was $35. Now it's more than 3,000. So this is the loss of purchasing power of the US dollar and of other currencies. It's not that the dollar is worse than the others. They're all equally bad because they are all controlled by central banks whose interest is not to have monetary policies that make sense, but monetary policies that facilitate the expansion of government. And so the government becomes bigger and bigger and bigger as a percent of the economy, and this retards economic growth. But equally in a democracy, if as a politician you go to the people and say, look, all these policies, they create inflation and we have to tighten our belts, it means either you get less subsidies, social security payments, whatnot, or we have to increase taxation. Are you going to get elected? No. But you can tell the people, because the people don't think. You can tell the people, we're going to punish the foreigners. We've been screwed by foreigners. We impose tariffs on the foreigners. A tariff is a tax on the US consumer, but it's not paid by the rich Americans. The rich Americans, they buy their private planes in Bermuda or in a tax haven. They buy them luxury yachts. They don't register them in the US. They register them in Panama or something like this, so they don't pay that tax in the US. Irving Fisher, who was one of the leading economists of the 20th century in the US, he wrote a book about money and so forth, and about the 1920s and what then led to the crash in 1929. And he wrote books about the boom and crashes and so forth and business cycles. I mean, he talked about the illusion of wealth. And I have another book that is actually very good in that respect. It's called The Penniless Billionaires, because the penniless billionaires are people like the ones that live in Zimbabwe. They're all billionaires, even poor people. But money doesn't mean anything anymore to them. So, when I grew up, my father used to say, if he wanted to talk about someone who was very rich, he said, he's a millionaire. Nowadays, people laugh if you say he's a millionaire. They talk about billionaires. But in my days, in 1970, when I started to work, there were 2 or 3 billionaires in the world. Getty, Rockefeller, and Mr. Ludwig. He was in shipping. And then in 1980-81, there were already 8 billionaires, and now there's thousands. If you come to a room and you say, this guy's got a billion, nobody's interested. Below 50 million, people are not rich. As I said, in monetary inflationary times, of course, there are some people that benefit. As you said, the rich people. And I want to make one thing very clear. I am not complaining for my personal conditions. You understand? I'm in the financial sector. I benefit from money printing, and I benefit from rising asset price because I own assets and I have no debts and so forth. So I'm in a favorable position. And as interest rates went up, my income went up. But the poor guys, the people that borrow money to maintain their consumption or live paycheck by paycheck, they have to borrow from credit card companies and God knows what. When interest rates go up, they're squeezed very badly. And that's why when the economists talk about wealth in America and how well the economy is doing, housing affordability in America is at the lowest level ever. But they don't talk about this because Wall Street wants to paint a picture that looks nice. And the politicians, they will say, under me, the economy is booming. Yeah, but the deficit is going up. The other day, I was listening to a panel discussion on Fox. I mean, you have to scratch your head about what these people know about, international relationships and so forth. They, in general, they thought the tariffs were very favorable for the US. I mean, in economics, we have different ideologies. We have capitalism and we have socialism and state ownership and so forth and so on. But one thing is fairly well established. The exchange of goods is favorable. There's no point to have agriculture in Manhattan. Manhattan should specialize on financial transaction, on insurance, on legal matters and so forth. You understand? And do the agriculture somewhere else in the plains of Montana or wherever. Anyway, so the exchange of goods is beneficial. And it doesn't matter whether Manhattan would have a trade surplus with Montana or vice versa. It complements the two economies that they trade with each other. And so different countries, they complement each other. I mean, to Trump, he maintains the Chinese ripped off the Western world, specifically America, of course. But quite frankly, when I see the workers in Asian factories working under not particularly good conditions, now this has changed because of automation and robots and so forth. That time they worked under miserable conditions. They manufactured Nike shoes for very little money, for which then Nike made the money by adding a huge profit margin. They bought the shoes in China or in Vietnam or India at $10 a pair, and they sold it for $150 a pair. The money was made not in China. The Chinese, they work like sweating. Money was made in the US and in Europe. So to talk about in trade who rips off whom is futile discussion because there are many aspects to it. In general, the Western world has benefited from Asia enormously. The cost of everything would be much higher and the quality much lower had Asia not supplied the Western world with textiles, toys, mobile phones, and so forth and so on. Believe me, do you think that Americans want to work in a factory all day long? Trump is dreaming. And I have to say, I would have voted for him because the alternatives are much worse. He's a clown, but he's an entertaining clown. The alternatives were clowns, but not very entertaining.